Okay, so here we are. We have a online quote for conventional mortgage insurance, and we're going to assume that this is a purchase. I put in a zip code. Housing expense ratio means what is the housing payment divided by the gross monthly income. I'm going to use 25%. Debt to income ratio is all of the debts, the estimated housing payment, credit cards, student loans, car payments, so on and so forth. Let's use 41. If you have one or two borrowers, you can put the credit scores here. We're just going to assume it's one borrower, and we're going to say that this borrower has 780 credit, which is excellent credit. Non-traditional credit is basically a credit report that's created out of collecting some bills. We're not going to go over that. We'll say that this customer is not self-employed. They are a first-time home buyer. They've never had a foreclosure and they've never had a bankruptcy. The program selection is standard. Now, there's lower income options, Home Possible and Home Ready. Home Ready's Fannie Mae, Home Possible's Freddie Mac. That's a 3% down program. If your income is 80% or below the average median income for the area that you're buying. Housing finance agencies, these are state bond programs. They typically will have different rates based on your income. But in this case, we're just going to go standard conventional. And we're going to assume that the buyer's putting 5% down. And we'll say the loan amount is $300. Non-refundable, refundable. I don't want to get into that in this video because that gets confusing. It's almost always going to be non-refundable, and it's going to be declining. Fixed rate, 30-year term. If you put 5% down, the coverage amount has to be 30%. And there you go. The premium in this case would be $80 a month. Now let's go back. And in this case, we're going to do 300,000 again, but we're going to change the credit score just so I can show you how much of an impact that has. This time we're going to put 720. It was 780 last time. $165. So the difference between a 720 credit score and a 780 credit score is more than double. It was $80, now it's $165. Now I'm going to go and change this. And this time, what we're going to do is we're going to drop the score to below 680. $670 credit score. Whoops. Everything else remains the same. Loan amount $300. All right. So the mortgage insurance premium for somebody with a 670 credit score and the criteria I entered, $337.50 per month. That's where government loans or government insured loans are often going to be an option that you want to look at. It may even be better than conventional. So I'm going to pull up FHA mortgage insurance premium. Okay, so what I've done is I put together FHA and USDA mortgage insurance premium so you can see the difference for somebody with a 670 credit score. So FHA upfront mortgage insurance premium is a one-time premium that gets collected at closing. Now, FHA realizes a lot of home buyers don't happen to have a lot of money to close on transactions, so they finance the upfront premium. In addition to the upfront premium, they also collect an annual premium. So the upfront premium is 1.75% of whatever the loan amount is. So the purchase price minus the down payment gives you the loan amount. They multiply that by 1.75%. They take that amount. In this case, it was $300,000 loan amount. So 1.75 is $5,250. They're going to add that to the 300,000. So now the total loan amount is 305,250. Then they're going to calculate the annual with the base loan amount, so 300,000, and they're going to multiply that by 0.55, and then they're going to divide it by 12 months, and that's 137.50. So FHA is more expensive when you add in that upfront mortgage insurance premium, but because it's financed, it often is a better choice for a lot of home buyers because the monthly premium is $137.50 versus $337 like a conventional loan. Now, if an applicant's going after USDA, the guarantee fee is pretty much the same thing as the upfront mortgage insurance premium, but they call it a guarantee fee. It's 1%, and that goes into USDA's general fund, just like the UFMIP goes into FHA's general fund. And then they collect an annual, which is whatever the loan amount is, or the loan balance. They multiply it by 0.35, and then you divide that by 12 monthly payments, and that comes out to $87.50. So as you can see, FHA and USDA will have a much lower payment, assuming all things being equal. Let's assume that the rates are exactly the same across the board. In a conventional loan, if you have a 670 credit score, it's $337 a month. FHA is $137.50 and USDA is $87.50. So huge impact on the monthly payment. And that's why the mortgage insurance premium is such an important part of the getting pre-approved process. And unfortunately, there's really just not a lot of data. There's not going to be good comprehensive calculators that you find online. They're going to calculate this properly. And if you miss this, when you're doing your estimates of what your payment's going to look like, you're going to be way off. And you're probably not selecting the right loan program. So in a nutshell, conventional is great if you've got great credit scores. If you're putting less than 20% down and your credit scores start to drop, then a loan officer has to look at the difference between the mortgage insurance, because typically the rates are pretty close. Sometimes the government rates are a little bit lower. So when you consider that the interest rate's lower and you consider the mortgage insurance premium's lower, even though you're paying an upfront premium, because it's financed, you're not going to feel it as much in the monthly payment. And that's where a licensed loan officer comes in, and they're able to break all these down and look at all the differences. And then they can come back and say, all right, if you want to do a home loan, this is probably going to be your best option. This is the reason why. And then they show you the monthly payment. But if you actually add up mortgage insurance over the long term, government insured loans are going to be more costly than conventional, because conventional does not mandate that you have to pay an upfront premium. And when the balance reaches 78% of the original purchase price, it automatically drops off. There's no more PMI, goes away. So over the long term, conventional is typically going to be cheaper. But because of the impact that it has on a monthly payment, if the credit score is lower and you're putting less than 20% down, sometimes government insured mortgage may be a better way to go.